Welcome back, and we're joined by Chokalingam Narayanan, who is from ICICI Prudential AMC, joining us this afternoon. Great having you here, Mr. Narayanan. Let's start with regard to the trends that you're seeing currently, and earnings have by and large been quite strong, right, for Q1. Do you believe this is structural? Can this sustain? And is this something that we can expect for the rest of FY27 and through FY28 as well?
Thank you, Harsh, and a very good afternoon to all your viewers.
Very good afternoon.
On the aspect of earnings, I think, as you rightly pointed out, the earnings season is kind of coming to a close, but it's been pretty strong. At the outset, a lot of us expected the season to be a little lackluster, given that war had started having an impact, and possibly some of the supply chain impact would have been felt. But thankfully, as we've kind of gone through the season, we've seen that that has actually gone past quite well. While we've had a little bit of impact on the volume side, I think the pricing impact has been better, and as a result, we've seen margins kind of holding up reasonably well across most, at a composite level. But there have been few sectors where the margin impact has been a little, pronounced. But that, I think, with a little bit of push pass through over a period of time, that should also kind of come through. So net, I think the economy is kind of reasonably in good shape. We also had, if you kind of looked at the monetary policy, the GDP estimates kind of being increased slightly. So to that effect, I think at the earnings level, things are okay. When you kind of look at it between large cap, mid cap, and small cap, you will see that the earnings growth has been slightly more pronounced in the small cap space, followed by large cap and then mid cap. But some of these numbers are slightly distorted by inventory gains or inventory losses, which are also sitting in some of the numbers. But outside of that, I think when you kind of look at it at an overall level, things have been actually reasonably good in actually the mid to high teens. So that's actually a good outcome. I think start of the year we were between the 15 to 18% handle as far as earnings for the different indices are concerned. I think that's kind of holding up as of now. So as long as that volume momentum kind of sustains, we should be reasonably okay.
And where has earnings surprised you on the upside? If you can give us that perspective, any sector, segment, pocket?
So when we look at it at a sectoral level, it's been when you kind of look at metals has been decently okay, textiles has been decently okay. We've had reasonably good numbers coming from banks as well. Consumption side, when you look at consumption of services, what we call as experiential consumption, that side has been reasonably good. Oil and gas has been better than expected, given that people were expecting higher inventory losses that did not come through. Thankfully, the refining margins were reasonably holding up better. So to that extent, things were good. Healthcare as well, the fall was not as steep as what people were anticipating. So that's also been okay. IT services was a little bit muted. On the FMCG side, some of the D2C companies have done much better, while some of the older incumbents have had a relatively muted growth. But even there, if you kind of look at it, F&B companies have done reasonably okay. Financial services, the capital market companies had a reasonably good quarter. Banks, as we already highlighted, were also better than what we started the quarter with.
Okay. Anything that you're liking at this point of time? Give us some color. What exactly is it that you're liking, you're buying in the market right now?
So we take a slightly more longer-term orientation when we allocate our funds for our investors. On that basis, we look at typically three things, which are the stocks that offer earnings growth, ROE improvement, and risk reward. This is our framework. We use our internal investment framework called BMV at ICICI Prudential Alternates. And this is a time-tested philosophy that's kind of held us good through cycles. When we look at 1, 3, and 5 year rolling periods and outlook wise, areas where we are quite constructive about is one, textiles, metals, auto hanks. You can say in some sense some of the old economy sectors in that sense, they are actually doing they're looking pretty well poised. The reason is possibly that supply chains are shifting, and today globally, as world is looking a little more insular, you're seeing the creation of alternate supply chains. And when those opportunities are arising, there is a case for some of these Indian companies to kind of better participate. And thankfully, the Indian government has also started signing up a lot of FTAs, and some of those are also opening up markets. Historically, we used to have a little bit of uneven competition in some of these areas. I think that is now turning on its head, and that's actually a good thing from the corporate sector. So some of these old economy sectors are particularly looking interesting, and we are more bottom up. So not everything within those sectors looks good. There are still one will have to be a little more choosy about them. Additionally, the other area where we think which is slightly more a decadal opportunity is, I think the consumer is moving more from consumption of goods to consumption of experiences. So to that extent, services is something as an opportunity that is emerging very strongly. So that's again an area where we are quite positive about. But in all these areas, it's not only about the narrative, it's also equally important to have risk reward in mind. So it's not you cannot paint it all with the same brush. So we are looking for that magic combination that we typically call earnings growth, ROE improvement, and risk reward.
Very interesting. I want to touch upon that services piece which you spoke about. How do you play that theme, Mr. Narayanan? Because it's a unique theme which is at play, and it's a niche one, right? So how should one play it?
Let's say, for example, if you want to consume, experiences, then you look at travel. So what are the ways to play around it? You could play it through aviation. You could play it through airport operators. You could play it through travel SaaS companies. You could play it through, retail companies. These are certain, ways and means that you can kind of participate in the experiential consumption as a theme.
And what about the platform companies? They too are into experience-based events and services. You play through that, or is that still too small?
No, so they are equally important. They are also another channel of retail. So, like I highlighted about retail, it includes retail in every form. So there are players who are stronger in each and every format. So we have to be looking at them on a bottom-up basis. So it's not every name within that bucket that looks great. Some are executing better. Some have better return ratios. And we'll also have to be mindful of valuations. So that is where we look at it. So we do have some of these names in our portfolios in pretty much, I would say, every format.
I wonder how you're looking at consumer durables and whether that's a theme that's looking interesting. You've got an LG Electronics, good set of numbers, some bit of margin recovery which is visible, 8.5% higher that stock price. But along with it, the numbers were not half bad, right? Crompton, the stock has been languishing for a long period of time. Now, I know you don't discuss specific stocks, but the theme as a whole, is that something where you could see earnings momentum sustain and a bit of a re-rating which could be on the card, just given risk reward?
Yes, it's a very interesting space, and as the wealth levels in the economy kind of improve, you will see increasing need for durables as a category. But here within this category, what we've been always grappling with is there is no one company that's kind of consistently kind of grown or not grown. The competitive intensity kind of tends to be on and off. So to that extent, I think pretty much in every category there is higher fragmentation. So that's one area, but there is one level, lower, which is at the integration level. If you kind of look at it, there are some contract manufacturers in which we've from time to time participated. That is one way of looking at it. But then in some of those contract manufacturers, working capital has been a bit of a issue. So which is where we need to balance both. So when we talk about at ICICI Prudential Alternatives, when we talk about earnings growth, ROE improvement, and risk reward, this is what we mean. So while we might like the theme, we need to balance that with whether the that magic combo is available or not.
Okay, interesting. Thank you so much, Mr. Narayanan, for coming in and speaking to us. Very good having you.
Thank you.